Welcome back to the channel, everyone. Is it game over for AMC? I personally don't think it is. So today I want to explain why not. Trust me guys, you do not want to miss this video. So stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 1,600 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, firstly I want to go through this article and then explain why it's pretty much entirely wrong. It's game over for AMC, but these stocks can still go to the moon. Following months of false or misleading information posted on social media, the AMC bubble is popping. Unlike AMC, 3 companies offer sustainable double-digit growth potential and significant upside. When 2021 comes to a close, it'll undoubtedly be remembered for the way retail investors made their presence known on Wall Street. Despite putting their money to work in equities for more than a century, retail investors moved stock prices like never before. The handful of companies these retail folks have piled into have come to be known as the meme stocks. Essentially, companies valued more for the hype they create on social media than their operating performance. At the top of the list for most meme investors is movie theatre chain AMC Entertainment, which until this past week was the top performing stock on a year-to-date basis. Wall Street and investors are wising up to the AMC pump and dump scheme. Unfortunately, AMC doesn't look as if it'll ever be going to the moon. The bull thesis for AMC, which disregards virtually all concrete fundamental data, relies on social media hype, constant misinformation and outright lies to fuel an artificially higher share price. The problem is that Wall Street and investors are wising up to the misinformation and deceptive tactics being employed by AMC's emotionally driven retail investors, known as apes, which has resulted in AMC shares losing 42% since June the 28th, with a lot more downside to go. To boot, virtually all claims made by the apes to ignite a rally in AMC's share price can be easily proved as false or misleading. Consider the following as 2 good examples of ongoing mistruths designed to artificially inflate AMC's share price. Shares sold short have declined from around 102 million at the end of May to about 75.5 million as of the end of June, according to official and not estimated data. Apes claiming short interest is climbing or shorts haven't covered are flat out wrong. This also severely dents the idea that a short squeeze is coming, which you'll hear echoed daily on social media without any proof or basis. Buying and short selling a stock has no impact whatsoever on the performance of an underlying business. This disproves the idea that short selling bankrupts companies, a core and blatant incorrect thesis of apes. And it also demonstrates that apes didn't save AMC. The capital that saved AMC from intermediate bankruptcy came from share sales and debt issuance in 2020 and early January. Operating performance, not buying and selling activity from investors, determines if a company is successful or fails. So firstly, I want to address the points in the article. Don't forget that the bull thesis for AMC isn't based on fundamental data. It's a short squeeze play. We don't really care about the fundamentals in the short term. AMC's shares have lost 42% since June, which, while technically true, is obviously being manipulated downwards, and we're still up like 1,000 or something percent since then, maybe even more. The second point, AMC shares losing 42% since June. While technically true, you have to remember that the stock is currently being manipulated downwards and that AMC stock is still up like over 1,000% since January. The next point, which is that shares sold short have declined from 102 million to 75 million per the published data, and therefore the short interest isn't climbing, can also be misconstrued as well. Don't forget, a lot of these hedge funds aren't marking their shares as shorted shares. They could just be marking them as shares on loan. The actual shares on loan figure per Ortex has actually gone up. Also, don't forget that this article only looks at data from June, when the AMC price ran up and a small percentage of shorts did actually cover. It doesn't look at the data for July, which is currently unreleased, which I think will show shorts going up massively. Let's consider it from a supply and a demand perspective. When demand is high and supply is low, prices go up because everyone wants to buy the stock. When supply is high and demand is low, the price goes down because everyone's trying to sell the stock or get rid of the shares. Currently, the AMC price is going down, which means that supply is outweighing the demand. But also remember that none of the apes are selling. Everyone's holding their shares. So it's not people selling the shares that's causing that supply to rise. Evidently, shorts are adding to their position, and this is what's causing the supply to rise. People aren't selling their shares, so supply isn't coming onto the market from that way, but hedge funds are shorting more shares, which means that they're borrowing shares and selling them. That's what's causing the increase in supply. And that is how the hedge funds are currently pushing down the AMC price. They're shorting more shares and adding to their short positions. But you could say, oh, hang on, Tom, why can't shorts just cover now at $30 and then the squeeze won't happen anymore because all of the shorts will have covered and the price won't move? Well, let's say at the end of May, a hedge fund had shorted 10 shares. In June and July, they've now shorted an additional 20 shares to push the AMC price down from around $70 to around $30, meaning they've now got around 30 shares that they've shorted. Because it cost them 20 shares to short the price down from $70 to $30, when they rebuy and cover those shorts, those 20 shorts, it will push the AMC stock price back up to $70 and they'll still be left with their original 10 short shares. Therefore, when the hedge funds cover their new shares that they've shorted in June and July, it will push the AMC stock price back up to $70 and we'll be where we were in May when they still had all of those shares to short. Now, the article does say that the number of shares shorted have been going down, but the number of shares on loan haven't been moving. And therefore, I imagine that the hedge funds are employing a number of different tactics to make the number of shares shorted appear as if they're going down and not going up. These hedge funds are marking shares that they've shorted as shares that are long and therefore aren't reporting them. They're failing to deliver and just moving these failed to delivers to different clearing funds and therefore aren't marking those. They're trading through the dark pool and therefore also aren't marking those or are marking them on a very delayed basis. But one thing we do know is that they're running out of volume of shares in the dark pool to short. When they borrow a share from the dark pool and sell it on the open market, they sell it to us. And therefore that's one less share that's in the dark pool for them to short. Don't forget, we can't sell our shares into the dark pool if the apes were selling, which they aren't. And therefore, even if we did sell our shares, it'd go back onto the open market for someone else and another ape to buy. It wouldn't ever enter back into that dark pool. We've also seen a massive increase in the number of bot comments on both Twitter and YouTube. Therefore, the hedgies are getting absolutely desperate and are trying to spread FUD wherever possible. Speaking of which, we're seeing more and more articles like this one from the Motley Fool and other sources like CNBC just trying to scare the apes into selling their shares. But it's not working. On top of this, the failed to delivers or the FTDs can't be passed around different clearinghouses forever. It does cost them interest and it does cost them a transaction fee each time, most probably in the multiple millions or even billions, and therefore they can't keep it going forever. I've got a few articles that reminds you of just that. I've been on this board since it was created. Many OGs holding the actual float are here with me. Pay close attention. Something exciting is happening before your very eyes, and we called it a long time ago. Since the beginning, we warned that as the squeeze draws near, bot and shill activity would increase. Pay attention. I'm not giving any false expectations. We love the stock. We will wait as long as it takes. That said, personally, I've never seen so much so often, and it's happening to GameStop or GME subreddit too. It doesn't matter what the topic is, but division or form sliding are key indicators of shill attacks. We're under heavier attacks than normal right now. Instead of getting annoyed by the manufactured drama and arguing, realise it's bullish. Strap in, where there's smoke, there's fire. Guys, let me know down in the comments below if you think it's game over for AMC or if you think the squeeze is just about to get started. And if you want to pick up some shares in AMC, but you haven't even yet signed up to a trading platform, be sure to check out the links down in the description below to Webull if you're in the US or Free Trade if you're in the UK to get some free shares with very low minimum deposits. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.